Right, hello everyone, and welcome to our latest webinar. So thanks ever so much for joining us. The topic for today is top regulation changes impacting employee benefits. So an exciting one today. For those of you who don't know, I'm Carl, so I'm the VP of Benefit Design and Partnerships here at Ben. Really looking forward to the chat today. Before we move on, I want to address the elephant in the room because, and I'm not talking about David. Promises were made and expectations set around me wearing a wig today, a judge's wig. However, I left it in the office and I'm at home today, so hence the fact that I'm not wearing it. And I've also been told subsequently that impersonating a judge is actually illegal. So as much as I'm in for making you guys aware of what's going on in the market and keeping you up to date, I'm not up for going to jail for it. So I'm actually glad that I'm not wearing the wig, although you've probably actually seen some of you may have seen the teaser email or video for this session that I was actually wearing said wig. If you haven't, then check that out on LinkedIn. We've got the usual format today, so questions down in the right-hand corner there. If you've got any questions, feel free to put them there, and we'll get to them as soon as we can, probably towards the end of the session. As we move through, and there's a chat function as well. So if you want to chat amongst yourselves, then feel free to do that. As always, I imagine the questions will end up in the chat, and the chat will end up in the questions. But if you can try and put the questions in the question field, then that does help us a lot. So whilst I've not got a wig with me, I do have David with me, which is much better. David, if you'd like to just do a brief introduction and tell everyone who you are, that would be super.
Thanks, Carl, and nice to see you all today. My name is David Pugh. I'm managing partner at ilumiti. We're all about prosperity through clarity. So whether that's supporting your staff with employee engagement, financial well-being, pension support, all the brokerage that happens around that. And we work really closely with Thanks Ben, so hopefully good support today. And I'm going to take the challenge of you not wearing a wig to bring an elephant into one of my answers. So I'm going to try and weave that in.
Nice, let's look out for that then. Great, that's awesome. Cool. Okay, and we want this to be interactive. So as I said, please do feel free to chuck some questions out. The three topics we're going to cover today are national insurance rises, so employer national insurance rises. I think we're all aware that's happening. Pensions reform and what's happening there, and then the EU Pay Transparency Directive. So in the chat function, if there's any, if you'd all like to jump in there and maybe sort of highlight the one of those areas that's probably most important to you or impactful to you, or the one you want to know more about, then we can make sure that we focus our time and attention on that one. So please do feel free to jump in the chat there. And again, if you want to have a chat amongst yourselves around how you're addressing these challenges, then again, it's a great place to have that conversation. Mm-hmm. Cool. Well, let's jump in then. So first topic on employer national insurance rises. So as I said, I think we're all aware what's happening here. Obviously, employer national insurance rising to 15% from 13.8 on the 6th of April. So obviously, it's a cost pressure on businesses, David. Right. So really interested to know, like, what are you hearing from clients on what they're doing around planning for budgeting for it, and then I guess as a sort of a sub question around how that impacts employee benefits. Are companies sort of looking at investment being impacted around employee benefits, do you think?
Good question. I'll start with a true story that I think illustrates the challenges companies up and down the country are facing. And it goes back a couple of weeks to half term, and I took the family to the zoo. I was to get my elephants in nice and quickly. And we had a great day at the zoo, but we noticed that the zoo hadn't actually got any elephants. And, who doesn't love an elephant? So, on the drive home, we're thinking, well, they need elephants. And as luck would have it, the very next evening, I was at the pub with a neighbour, and his friend joined us, who was governor of that said zoo. And I was hoping to get into the conversation where the flipping elephants. And I didn't even mention what I did. And before I kind of got into that, he was explaining the pressures on their business of the national insurance changes. because like many businesses up and down the country, they have lots of staff who aren't highly paid, and so they're going to be very hit by the national insurance, and they're not making a profit. Now, the companies that I think are hit most are where they've got lower paid staff, because it isn't just the increase in the rate, they're dropping the band from which you start paying the national insurance. So there's a double whammy. So surprisingly, the zoo doesn't have as much turnover as I would have thought, but this double impact to the national insurance costs them £400,000 and they don't make any profit. So the impact there is, well, where do they make that saving? So I didn't get around saying, where are the elephants? Can we have some elephants? Because there's nothing new that can be done. They need to cut their cloth differently. And so that's really a metaphor, I think, for lots of businesses around the country. How will they cope with that? I think most of our clients are, profitable growing businesses. They've got different challenges, and they kind of cope with whatever's thrown at them. But relating it back to benefits, we've taken on several clients in the last 12 months where their traditional brokers, their existing brokers, have kind of come up to them with more problems. Medical insurance costs going up, insurance costs generally going up. And so at a time where there are other cost pressures, additional ones just don't fly. So we've had to come to the table with ideas to negate those increases, shape things differently so that you can still offer the same kind of core headline, but maybe with different options to really manage that cost downwards in this environment of those additional costs.
Yeah, and you're right. I mean, there's a lot of cost pressures on businesses at the moment, but I think I suppose I've heard a few companies sort of refer to the inability to increase or invest in employee benefits as a result of as a direct result of this national insurance increase, which I think is worrying in some ways, because obviously companies want to invest in their people, and there's and we all know the benefits of doing that. And I think it seems to me that employee benefits seems to be an easy route to cut costs, or seem to be sometimes an easy route to cut costs to cover some of these enforced increases of other sort of charges, like the national insurance increase, for example.
Yeah, no, agreed. It can be for some, but I think you need to turn it into, where is the opportunity?
Yeah.
And how does that link with these rises? And I'd break that down into two areas. Firstly, can you change the narrative at all around the change? Because yes, it's going up, but how can you link that to, let's say, pay reviews, so that maybe you can get some credit back for that? Because it was only last year that national insurance rates dropped for employees. And so that's easy to forget that they went from 10 down to 8. So that's a 2% pay rise last year. So if we can kind of bring that into the conversation at pay review this year, I know can be a challenge to do, but if you can be open with staff and communicate in that way, then maybe you can moderate increases this year slightly, and then focus on the added benefits that you've got of working for an organisation, so that you're not cutting back on them. That can work really well. But secondly, it's how can you maximise the tax efficiency of employee benefits, because that can drive savings really positively. We could do a little quiz, what are the top employee benefits where if employees take them out, you save money. And I could think of 5. Yeah. If anyone can think of more than 5, please shout. And I think every company can offer all 5 of these, because they don't necessarily cost any more money to do. I was jotting down earlier, so there's obviously a pension. If you fund your pension through salary sacrifice, and perhaps if I can share a case study on that in a second, there's a saving to be made there. So whatever your current employee contributions are, there's a potential 15% saving on those. But have you got bikes to work? It's only a few people that might do that, but it creates a saving. It costs nothing, and it's a benefit. It's a nice headline. EV cars, the same thing. Broadly speaking, an EV car, one car, can save the business £3,000 over a 3-year lease period. And that's a cheaper EV car. So again, it shouldn't cost anything to offer. There are ways now of mitigating the risk. We had one new client this year, or in the last 12 months. He said, we've got a whole car park of EV cars for people who've left. And we're like, well, why haven't you protected yourself against that? You can protect yourself against it. And through your platform, it's really easy to buy and sell holidays, and buying holidays, the savings there. And number 5, and I'm guessing this is one that a lot of people might not be aware of, is every individual has a £500 tax-free allowance for getting advice in the workplace, typically pension advice. We've got a few clients who use that as a flex allowance, and so it's really costing the company nothing to use that. And we've got a few clients who actually give staff a token to use, so it is costing money. But if you do it in the former way, you can make this freely available, and then if employees take up the offer of whether it's well-being, whether it's financial coaching, whether it's financial advice, the cost of that is then deductible for the individual, so they save tax and national insurance on it, and the company saves 15%. So that's my very long way of saying that there are several benefits that we can use that will save money and cost nothing, so that can hopefully offset any downward pressures on support services, the actual benefits themselves.
Yeah, absolutely. And I think, we shouldn't underestimate the value of some of those savings as well. You sort of articulated the electric vehicle car leasing piece there, but any company that's not salary sacrificing their pension that has the ability to do so, that can be huge amounts of savings. Equally, like you say, the electric vehicle car leasing, cycle to work, holiday buying, workplace nursery was in the list, but it's more of a cost neutral thing now because of the payments into the actual nurseries themselves, and then the financial coaching element. So I think, we have an NI savings calculator that sort of looks at average take-up rates on those schemes. So if anyone's got any, wants some calcs run, equally, I'm sure, David, you guys would be willing to help out there as well. So
yeah, absolutely. Could I jump in with that case study on?
Yeah, let's do it. Yeah, let's do it.
This is a big fat figure that can make a real difference. So real example, a software engineering firm last year, 200 staff. Growing, flexible working, had a traditional broker before we came along, and I'm sure something that will resonate with many. There's just a low level of employee understanding and poor engagement, but they were doing salary sacrifice, so there was the ability for the company to be saving the national insurance on the employee contributions and the employees too, but they put it in place many years ago, and they were leaving half of the savings on the table. So it never ceases to amaze me how many companies don't use salary sacrifice at all, but there are a lot more that have salary sacrifice for pensions, but they don't have the process working to capture all of the savings. Maybe people had to volunteer to do it in the past, or whatever it would be. But when we drilled down, there was £68,000 worth of potential savings not saved. So that was broadly half the staff hadn't done what they needed to do to enroll in the salary sacrifice. So we simply did a process change. And by changing that process, we could sweep up all of those savings for the people that should be doing it, and taking the precautions to make sure that any people that shouldn't be doing salary sacrifice weren't. And we used half of that saving to effectively engage more in the benefits, specifically the pension. So digital support, presentations, great communications, one-to-ones, a helpline, support to the company, and with that support to the company, better governance, so that the pension was improved, the charges were reduced, the funds improved. So the company has saved £68,000. They've reinvested half in terms of the engagement and the support. But to the individual, they've still got the same pension. It's just working better now. It made a 38% difference to the outcome at retirement. So what I mean by that is the projected pension would be 38% bigger. So if you think about the cost of increasing contributions by 38%, it would be hundreds of thousands of pounds. Just by working it better, using salary sacrifice, that made a big difference. And then the plan is, because this particular company, they had to plan ahead before they could have a flex platform, that other half of the saving will fund the flex platform in 12 months' time, and that just took a bit longer. But the salary sacrifice saving we're able to bring in pretty much immediately.
Yeah, that's really interesting. And I guess along a similar theme then, as we know, I'm sure there's people on the call now that are doing this. So companies reinvesting the employer national insurance savings into the pension, on behalf of the employee, or giving it back to the employee in some way, shape, or form. What are your thoughts? Do you think some companies are going to start to think, well, maybe we can't do this anymore? Maybe we need to not offer the extra 1.2% or retract some of the 13.8% that we've given back in the past?
I mean, most of our clients don't pay it back to staff. They keep
Okay.
it because of all the cost pressures. But we are converting an older pension to salary sacrifice at the moment, and they want to give all of that back. They haven't got enough kind of freely available money to increase the benefits in any other way, so they just wanted to give it back. So yes, we have seen that, but I would say for every one like that, there's probably 9 where they keep all of the savings themselves. And if I go back a lot further, pre-auto enrollment, which is going back a long, long way now, we found most companies gave back the saving. But post-auto enrollment, pension costs have just got up and up. So generally they've, anything new they would keep, but a lot have now gone back and converted what used to be a saving to the individual to be a saving to the company. If it's kind of broadcast at the same time as other improvements, that can be a nice win-win.
Yeah. And I imagine those that are doing it, it's probably quite difficult to retract that now. Maybe that's something they can do, but I guess it's probably an option for companies to revisit their strategy on what they're actually doing around national insurance, and when they are repaying it back to employees or retaining that lump sum.
Where we've seen it done recently is where you've got these different populations of people through acquisitions, two-peers, that kind of thing, and you've got these anomalies. And often, yes, something's given back, but maybe they've got lower terms and conditions somewhere else on the pension, on the benefits. So when you look to harmonise, that's something that you might do at that point.
Yeah, absolutely. So, I think in summary then, there are ways that companies can, use employee benefits to get savings back, actually bigger savings than they would have got before because of the increase in national insurance, employee national insurance. So I'd really love, people to jump in the chat or in the questions, ask any questions you've got of us around this, but also in the chat function, like for those of you that don't offer salary sacrifice pensions, or you're not offering those other ancillary benefits that can make savings, what's the barrier to entry for you guys doing that? Is it the admin burden? Because Ben can solve that. Is it something else? Is it perhaps a lack of understanding of how these things work? We'd love to hear from you guys if you've got any thoughts around that. Cool. Okay, let's move on to topic number 2 though, while we wait for people to have a think about that particular question and challenge. Pensions reform, right? So it's been 20 years since I've worked in pensions. I used to do triennial valuations for DB pension schemes, working with a load of actuaries at Norwich Union. I tried to block that out of my memory, but there's always something going on in pensions, right? I think my 25-year career in employee benefits, I don't think there's been a year or two without something happening in pensions. So what's going on, David? Break it down for us.
This is potentially better news than it could have been, because back in 2023, I'm not sure if it's the last Conservative set of pension changes they were planning, but they were looking at kind of moving auto enrollment to phase 2. So phase 1, nothing really changed. Everything was pre-programmed in advance, and 10 plus years had gone by and nothing much changed. So the plan was to expand the scope of auto enrollment, to make it available to younger people, and to drop the lower earnings limit. So particularly lower earning people would have more money pension, so basically from £1 pension. With Rachel Reeves' first budget, all those plans have been scrapped. So it had actually gone through Parliament. It was coming into force. It's all been scrapped. So we don't anticipate that coming back anytime soon. And I'm guessing that was, well, we need everyone to pay more, so let them pay more national insurance. Let's not ask companies to pay more into pensions. But it is needed. There was good support for these changes, because it's to be applauded that companies should be putting more money into pensions for more people, but they don't have to. So reform there is on hold, but 2 other areas that are relevant. One is around pensions and inheritance tax. So more of an individual issue rather than a corporate issue. But pensions have always been heralded as the best tax wrapper, the best investment wrapper for tax purposes. And with pension freedoms, so going back a few years now, pensions became excluded from your estate for inheritance tax. Well, come 2027, they're back in. So that's not great news, but pretty much all other investments are part of your estate. So it's a bit of an equalizer. But every budget, now I can go back sadly more than 25 years in pensions, only just. Pretty much every budget, there's been rumours around, will higher tax relief be removed? Will the ability to take a lump sum free of tax out of a pension be removed? And that was probably rumoured more than ever in Labour's first budget, but it didn't happen. So out of all the bad things that could have happened to pensions, this might be the least bad because it doesn't impact until you die. And for most people, it won't be that significant. But I think you do need to look out for your senior directors, those with bigger pension funds, because there were already penalties on death for bigger pension funds. By bigger, I mean broadly more than £1 million. So you have a penalty and then you have a 40% tax charge. That sucks. So some work is needed there. And then the only other thing I think on the agenda for pension reform, it's often referred to as the Mansion House speech. So with those big, massive pensions that you used to work on 25 years ago at Aviva, DB pensions, occupational DC, the government are looking at how, if you like, unallocated money can be freed up to invest in the UK. This is all kind of going through consultation, how can it work? But it's trying to use pension funds to reinvest in the UK into infrastructure projects, something they could broadly do now anyway. So I'm not sure if that's just more of a political thing, but I don't think that will directly impact too many of the people listening today, unless they have got a defined benefit pension scheme.
Sure. Okay. So on the reform piece, then nothing to necessarily worry too much about, nothing to do, or is there any action that companies need to take?
Yeah, I don't think there is too much action. I mean, hopefully you're checking in with a good pension broker. We've certainly made all of our clients aware of the years, what's coming up. So yeah, I can't comment if people haven't been doing things they should have been doing before. But for our clients this year, there's nothing much that is new there. It's just a continuation of all the good work that they've been doing to date.
Yeah.
And importantly, there was some work we thought was going to be needed that now isn't needed. So it's just being clear on what that is, because if you don't get the update, you could be pressing ahead with some work that is now redundant.
Okay, and is there you got any further details on that, David, or is it
so?
In case people are
I'm referring to the auto enrolment changes that were planned,
okay,
where they were going to drop the age from 22 to 18. They were going to drop from the lower earnings limit to £0, and that's now not coming through.
Yeah. Okay. Fine. So if you're doing anything around that at the moment, then you might want to stop. And that's been kicked down? Has the can been kicked down the road, or is that stopped indefinitely? Or
I think it's beyond kicked down the road. That they're saying there's no intention to pick it up. So that's well and truly kicked into the long grass.
Okay. Anything else on pensions people need to be aware of, David? Anything that's happening at the moment?
As we said earlier, I think the big opportunities around salary sacrifice, if you're not maximising it, and even clients who are properly doing it, getting all of the saving, the more you can engage your staff with pensions, the more you can help offset some of the national insurance increases. As you said, everyone's got more national insurance to pay, but benefits which are salary sacrificeable, you're saving 15%, not 13.8%. So yes, you're paying more on one side, but you can get more back on the other.
100%. Couldn't agree more. Cool. Okay. And then again, anyone got any questions around that, feel free to chuck them into the questions channel. Let's move on to topic number 3. So the EU Pay Transparency Directive. Quite timely that we're talking about this, bearing in mind it's International Women's Day on the 8th of March, which I believe is Saturday. Interestingly, we have a webinar on International Women's Day next week as well. I was told about that earlier. I asked who was hosting it, and apparently I am. So obviously I think I probably was fully aware of this, but just for some reason forgot. But anyway, you'll all get an invite to that. So I'll see you all next week. But it's looking forward to that one as well. And jokes aside, things like EU Pay Transparency Directives, gender pay gaps, We shouldn't just be talking about this once a year either. On International Women's Day, we should be talking about it all of the time. But there is a directive, and I don't know too much about it. I know the headlines, in that any company that's reporting a greater than 5% pay gap in the EU is going to trigger a pay assessment. Around recruitment, there's new legislation around pay bandings being articulated to candidates. I don't think this comes in until 2026. And also, it's worth mentioning this is the EU, and obviously the UK is outside of the EU now, so the UK isn't directly impacted, but obviously employers that have employees in the EU. And also, you've got the UK employment rights bill, which actually requires UK employers to produce annual equality action plans on gender pay. So there is UK legislation that impacts this as well. I guess bringing this back into the world of employee benefits, David, like EU Pay Transparency Directive, how's that impacting employee benefits? You got any thoughts on that?
Yeah, I mean, it's certainly getting trickier. And as you say, this doesn't come in until next year, but lots of companies will have adopted it earlier. And care is needed because most of our clients have presence in the EU, even though most of them are based in the UK. So if you've got more than 100 staff spread across Europe, then you are caught and you've got to report for them. So one good thing is it is equalising rules around Europe to one set, which makes it easier. And I guess most companies in the UK of a size have been doing this for a few years anyway. So it is different, but it's on the same thing. So how do we link that back to benefits? Well, yesterday I was reading that with ISAs, so a savings account effectively, also has a gender gap. Interestingly, more women than men have ISAs, but more money is in the average man's pot than women's pot. So men are putting more in. They might be more aggressive with how they invest it. There's always been a gender gap with pensions, which can be quite big. And through your pension governance, are you monitoring that? Are you seeing why that's happening? Are you doing anything to try and address it? And I think Scottish Widows kind of lead the way there with their Women Pensions report, which they've been doing for many, many years. So I think the question is more around how can we help address these inequalities through benefits? And particularly where we're talking about savings, so whether it's ISAs or pensions, savings take time. You don't just suddenly acquire savings. It's regular disciplined behaviour over a long period of time. So there will be no quick fix. But I think you can take a big step forward if you have a really good, well-communicated financial wellbeing plan. And it doesn't need to be segmented by gender. I mean, if it's simple, if it's clear, if it's engaging, it should be appealing to everybody, whether they're young, old, whatever the gender, wherever they are in life. And I think that fits really well with what you guys do at Ben. So, I mean, can I turn it back to you? How can a flexible benefits platform make these things a little bit easier?
Yes, yeah. I mean, it's interesting, isn't it? I think from a sort of benefits perspective, I guess, platforms like ours, we're very good at. So I think part of the problem when it comes to benefits, right, is education and communication and engagement, right? And I think that's where platforms like ours really come into their own in terms of meeting people where they're at in terms of communication, right? So educating people through short form video content, through text, through technical guides for those that still read them. And I think flex can be a great leveler as well. So obviously, if you're giving everyone choice ultimately to shape whatever they need in terms of benefits, then I think it's a great leveler in terms of some of these equality conversations, because ultimately you're giving people access to the things that they want, right? So you're not saying, I think like you can almost in the past, if you're taking a fixed approach to benefits, we used to say 40 years ago benefits were designed for white middle-aged men, right? And they were, because they were, that's just the way they were set up. Everything was considered towards the average employee because you had to, because you were offering a one-size-fits-all approach. So if you're going to one-size-fits-all benefit, you're going to position it towards the average employee. Now we don't have to do that, and that's where flexible benefits I think comes into this, and where choice, flexibility, platforms that facilitate all of that access through intuitive systems with intelligence, bled into that as well. And that's something we're really passionate about, the intelligence piece as well, and having AI as a co-pilot for employees and employers in that journey. I think that's where flex becomes a leveler, I think, in this broader equality, conversation. I do think as well, I think it's an opportunity, I think, when legislation comes in like this around this, the EU sort of Pay Transparency Directive. I mean, the reporting above sort of 5% gender pay gap sort of, I guess that triggers me a little bit. Why is that not 0%? Why 5%? But I guess it gives companies an opportunity to consider, well, what else can they do in terms of the maybe HR professionals in terms of benefits around equality and gender equality. So I suppose the thing that sort of springs to mind is sort of leave policies and things like that. I think we often talk about things like maternity versus paternity, and everyone, some companies are moving paternity into the realms of maternity cover, and that automatically, I think, springs or makes people start to think about, well, that's only a benefit for the father, right? But actually, I think it creates equality, because then fathers are out of the workplace, or can be out of the workplace for the same duration of time as the mothers are. And for reasons that we don't need to go into, females still are the primary caregivers. So therefore, I think we can create more of a parity in terms of time spent out of the office, and therefore, therefore things like men not being deemed to get further ahead because they're in the office when women are out having, looking after children. I think that's a leveler. I also think things like workplace nursery plans. So again, facilitating access to affordable plans that, again, make it easier for women to come back into the workplace, and cost not being a barrier to that, are all really really important areas in this sort of transparency piece. I really do feel quite passionate about this, and I think it's something we should all be looking at and really sort of honing in on, I think. Cool. Okay. So we're finished with the three main topics that we aimed to discuss today. We've got a few questions, so let's jump into those. So the first question, David, is, so with all these regulatory changes happening at once, where should employers focus their attention? What's first? What will have the biggest and longest term impact? So I guess just to sort of answer that in some way before you do, David. So I guess this isn't necessarily all happening at once. So I think the EU Pay Directive is 2026. I think June 2026, but don't quote me on that. Obviously, the employer national insurance stuff is imminent. So that I guess that would be our suggestion in terms of a primary area of focus. Would you suggest, David?
Yeah, I mean, hopefully some of this stuff you've been thinking about already. And so, yeah, like with any problem, you've got to think, well, what order do you tackle them in? And are there any that aren't relevant at all to you? Maybe pension reforms, maybe the EU gender pay related things, depending on your size and where your people are. So, yeah, first of all, make sure it is relevant and then prioritize it. And I think ideally with all these things, you want to try and relate it back to your company mission. What are the company objectives, values, goals? Which of them are more aligned with that? So yes, you can't say, well, paying 15% national insurance isn't aligned, so I'm not. There are some things we have to do. You can't change that, but the impact around it and what you can do as the way of softening it. If you can align that with what the company is trying to do, bigger picture, you get a lot more buy-in for the solutions that you're coming up with.
Yeah. And I think, as well, I would, if people are not, if companies are not offering things like holiday buying, and I guess holiday buying is a slightly difficult one. There are some industries where that's a real challenge, and I accept that. But things like, if you're, and again, if you're a low, if your workforce is low earning, and you've got, a lot of people around the national minimum wage, I understand the salary sacrifice pressures there. That aside, and those that aren't in that situation, those that are more white collar, fairly affluent workforces, if you're not offering things like electric vehicle car leasing, again, which, most companies will have ESG sort of targets, either imposed or self-imposed. And certainly from the E perspective of that, then there's some some benefits to electric vehicle car leasing. The barrier to entry to these things is really, really low. Like, you don't have to pay anything. Some of the certainly electric vehicle car leasing, the best providers like Tusker and Octopus EV, all of the protections are in place that you don't get you're not going to get lumped with 20 cars if people leave the business. It's all of that protection's in place to both employer and employee. It really is a no-brainer, I think, in many situations. So certainly those sorts of things. The financial advice piece. Speak to David and his team about that. Absolutely. I think there's some interesting stuff there as well. But certainly worth considering all of those areas. Another question here from Chloe. So if you already provide pension savings to employees, is that something you can retract even if you're not going through TUPE?
Generally speaking, you'll need to consult. So if you are changing a provider, you can generally do that without consulting. But if you're changing how much you're paying in, so you're making it monetarily worse, then you need to consult. You can't go below minimum standards. So the auto enrollment kind of minimums that people were of 3% from the company. But yeah, if you're currently giving the national insurance saving back, if you don't want to do that anymore, you could simply communicate to everybody, hey, we're planning on doing this. Please give us your feedback. That's a good consultation. 60 days later, you announce the result of the consultation, and then you can implement a change. So I'm kind of making that very simplistic. If you want to take hearts and minds on the journey and not make it feel to staff that they've been ripped off, you need to put a carrot there as well. That carrot could be EV cars. It could be a whole range of other corporate things you're putting in place. It could be more support on the pension. Personally, I'd far rather have £99 invested into a good pension that I understand, that I'm empowered to make good choices on, than £100 going into a black hole that I don't understand. And that's the kind of dynamic that we look at. It's worth spending that pound on making the £99 work for you.
Yeah, that makes a lot of sense. Another question here around advising or communicating changes and impacts to employees. So I guess it's an interesting one, this one, isn't it? Right, because these are things that impact employers, but then obviously there's a knock-on effect to employees potentially, right? So how much of this stuff that we've talked about, the national insurance rise, the pensions reform, how much of that should be communicated to employees, and how much of that how much of that, I guess, is more of a nice to do rather than a necessity?
Well, I think where pension reforms were planned and now they're not,
yeah,
employees don't need to know about that. That's just boring, isn't it?
Yeah.
You could argue people in HR don't want to know about that. Tell me what I do need to know.
Yeah.
But in terms of national insurance, well, you don't need to communicate. It will just come in through the pay slip but this is a change that employees won't see because it's on the employer side.
Yeah.
So that's where I come back to, well, if you do have an open, honest dialogue with staff and you are sharing results, different things, I personally think, as an employer, that it's really good to make staff aware, well, our costs are going up. You had a saving of 2%. You had a 2% pay rise from this last year. So yeah, we need to be grown-ups and we need to be thinking about what impact that has. So you can use these reasons to partly justify decisions, actions that will be coming down the road. And even if you don't need to tighten the belt because of these things, it's still worth mentioning it because there's some credibility that you can get from that of, going above and beyond, because most companies out there will be making difficult decisions.
Yeah, absolutely. And I agree with I'm all for transparency, right? And I think especially if the rise in employer national insurance is resulting in you having to make a difficult decision that does impact employees, I think it's just right to be open and frank and honest with people, isn't it? Again, like that, moving out of this world of paternalism that I hate in employment. All right, when you sort of think about people having financial struggles, you don't tell your children about it, right? Fine, fair enough. But you don't. But again, like, we shouldn't have that parent-child relationship in the workforce, right? People are adults. I think it's only fine it's only right and appropriate for companies to articulate cost pressures to their employees.
Yeah.
Cool. Right, we've exhausted the questions. I think. Let me just have a quick check. Yep, we're done with questions. If anyone's got any last-minute questions, your time is now. If there's nothing pop up in the next couple of seconds, then we'll close there. First of all, a massive thank you, David. Like, we couldn't have done this without you. And to anyone that wants to follow up with David, do you want to just I don't know if you want to just reference how they can get in contact with you quickly?
Yeah, you put me on the spot there. I mean, through our website, we've got our contact details, so ilumiti.co.uk. I'm sure we'll follow up with our contact details to the attendees, if that's okay.
Yeah.
And yeah, if anyone's got any questions, we're delighted to have a chat. Excellent.
Cool. So thanks again, David. Like I said, it's been a really interesting discussion, and really value your input. So thanks ever so much. We'll close there, and thank you all for joining, and we'll see you on the next one.
Have a great rest of the day. Thanks, Carl. Thanks, everyone. Bye for now.